Welcome to the Freedom Founder Podcast. I'm your host, Zach Duggar. Now, my guest today, Stewart Heath, joins me, and he will be talking a little bit to us about his own experience in business and in life. So, Stewart, thank you for joining me today.
Thank you for having me. It's quite the honor.
And I may have said Stewart Heath because I just popped in my head, but Stewart Heath. All right. So
it happens all the time.
I get a lot of variety in my own pronunciation. But that said,
yeah,
love to talk with you a little bit about your experience in the entrepreneurial space. That's what this podcast is all about, is just sharing the journey, sharing the experience so we can learn from each other, be inspired by one another, and be motivated to get to our own next level in our own life and business, whatever it is that we are doing. So let's start with, what are you doing today? Let's start with present, and then we'll go a little bit retroactive after that.
Yeah. Mainly what I'm doing today is real estate investing. Through our arm, Harvard Grace Capital. And I've always kind of loved real estate, came to it really from the other end of the spectrum. I'm a CPA, and I had my own practice for a number of years, and I watched how many of my clients grew wealth slowly through real estate. And it does sort of feed my my desire for creativity and my need for independence and growing wealth. And it's me and real estate fit each other very well. But I have spent most of my career doing entrepreneurial things. I think my first venture was a employee leasing company, and then there have been many others along the way. So. Real estate's my love.
The passion that you found and continue to enjoy. Now, let's go back to that beginning. You said that you had an employee leasing company. How did you get into that? What got you into employee leasing? And for those that don't know, what is that? What does that mean?
Employee leasing is essentially a way for smaller companies to aggregate things such as health benefits and workers' comp costs, and the employee leasing company will have a much bigger pool and get much better deals on benefits and work comp costs and payroll administration and things like that. And then the client ends up just paying the employee leasing company much like you would any other vendor. And it can be a good deal for a lot of folks. For a lot of service type businesses, it may not be a great deal. Usually for heavy labor type industries where your workers' comp costs might be challenged or out of control, usually you'll get some benefits by aggregating that with other people, especially in the construction industries or anything where labor is intensive and where you might have not a high rate, but a moderate rate of workplace accidents and things of that nature. That's the general idea behind it. These days, almost all the big payroll companies, Paychecks, Insperity, and things like that, they all have an employee leasing option. And so it was kind of new and novel back in the 1990s, and I was always trying it. And I completely misestimated the number of headcount that I would need for that to break even. And we did that for about a year, and then gave it up. Still like the model. I've had a lot of clients, and I have used it over the years, and it's the perfect fit in the right situation.
That makes sense. And I think that is important, that when you have an opportunity to explore opportunities, and sometimes you learn in that process, underestimate certain aspects of that new venture, but it always brings you to that next step in your journey. So tell us about that next step for you. Where did life take you from there when you no longer were running that business?
Well, and all the while I was doing a CPA practice along the way. And always trying different things. At the end of the day, I didn't ever really intend to practice as a CPA for
Hmm.
forever. I was always trying to get into something else. Um, I like to say I have started dozens of businesses, and a few of them are still in business.
Uh,
So there is a lot of the trial and error. I think the most notable thing after that one, after the employee leasing, was I was a partner for several years in a physician's billing company
okay.
back in the late '90s, and it wasn't something that I knew a lot about. I came in as CFO and a partner,
Hmm.
and then learned a great deal about. I had some partners who'd been doing healthcare billing. It's very, very, very specialized type business, uh, and if you've ever been to the doctor and gotten one of those what they call a super bill, where
Hmm.
they have 300 things on a page and then they check off what they did for you, and then that equates to a bill that they end up billing your insurance company or Medicare or whatnot.
Yeah.
We provided a service that submitted those bills and tracked those bills and handled any questions about the bills, and all for a percentage of the collections.
Okay.
And we were pretty good because we would come in and take over a physician's billing. Maybe they got behind, maybe their other people hadn't done, and we could collect a lot of old stuff for them,
Hmm.
and then and then you keep it clean, and we would usually do it a little cheaper than everybody else. And I left that business selling out to the other partners. The
Hmm.
pool just didn't. It was very competitive, very cutthroat, and 2 or 3 times we had gone into doctors' practices that where we collected several $100,000 of back billings for them,
Hmm.
and they was like, great. And then they would throw us aside for somebody else who would do it for 0.5% cheaper than
Okay.
we were doing it. And so, and that's very typical in the medical world.
Hmm.
I don't deal well with industries without a lot of loyalty to them.
Sure. Yeah, I can understand that. Makes
Yeah,
sense. There's certain things that you did and you did a great job for them, but then they can save money even a little bit by going with somebody else.
yeah, yeah.
They do that.
Yeah, they do
Yeah.
that.
Okay. Well, that's understandable. So yeah, as you continued to be a CPA, you mentioned something that I think is really key. You mentioned that you're seeing clients who are building their wealth slowly
Yes.
by investing in real estate. And I think for some, they will think about that as, I can't even get into real estate because I don't have enough money to do so, or I'd rather go and do this other thing because I can make more money today than I could if I had that rental property only paying me a smaller amount every month. So tell us a little bit about what you mean when you say building wealth slowly.
Yeah. Well, I completely understand the desire to. Well, I would really rather go do this other thing
Mhm.
um, because it will make more money. And that's assuming that the business plan is executed flawlessly and everything goes according to plan. Um, your other entrepreneurial plans may be more risky than a piece of real estate. And trust me, I've done all of those
Mhm.
before. Um, and I'm not here to dissuade anybody against going for their passion
Mhm.
or dream or whatever. Yeah, I finally got to the point where, and I do really enjoy real estate. Real estate is the most stable asset class
Mhm.
on the planet. I do laugh and chide Wall Street people, for putting real estate over as an alternative and group us over with
Mhm.
art and Bitcoin and other cryptos. No, no, no. We're not alternative.
Mhm.
Real estate's the original asset class. So,
Yeah.
and it's not as though like the IRS would tell you that it's passive. If you're managing your real estate, I can promise
Mhm.
you it's not passive.
Mhm.
And there are opportunities to be entrepreneurial with it. There are all kinds of opportunities with many pieces of real estate to add revenue streams, to reposition it to do something else, which
Mhm.
are all very entrepreneurial activities. So I got there, and again, from watching clients,
Yeah.
and many of them struggling. I mean, one in particular, I call her my business mom. Um, but she was an award-winning real estate agent in Nashville, and when she became my client, she owed the IRS a couple of $100,000
Okay.
from a big mess. And so that's how I got connected with her. I helped her navigate that. We negotiated with the IRS, and we did all that stuff, and we got her not only out of that, and the whole time she's doing fix and flips and buy and hold small apartment buildings and stuff like that. And I came out of college in the late 80s, and right about the time of the real estate crash that was part and parcel to the 1986 Tax Act. And so I sort of came out of my infancy of business thinking, oh, real estate's bad. Real estate's bad.
Sure.
And after about 10 years into this, and certainly after I had left a big accounting firm and doing my own firm, I'm watching these people who are making progress. And so really I just sort of had an epiphany, and this stuff works.
Yeah.
And it's also the most leverageable asset on the planet. So you don't have to have all the money, and which kind of goes back to the original question. Do I take $10,000 and go buy a piece of real estate, or do I take $10,000 and do a new venture, some sort of a side hustle thing? And I can't answer that for you.
Sure.
Both are valid options that each entrepreneur has to decide for themselves. The thing with leverage is you can take that $10,000 and buy perhaps $100,000 asset with it, and you get the growth on $100,000 rather than the growth on $10,000.
Yep.
Your successful entrepreneurial venture might be a 10 or 20x, so it might do far better. But again, real estate tends to be stable, which is why I gravitated to that eventually. So that's really kind of how I got there from doing other stuff. After my first duplex, I realized I really like this, and so to me, being an entrepreneur, which means we're kind of abnormal in the general population anyway. Most of us have ADD of some kind or another, and when I discovered that I really liked it, it was just Katie bar the door, and I've just pursued it for 20 years. So.
Yeah, absolutely. Can you give us an example of kind of what kind of returns? And I know this would be very hypothetical, but maybe even in your own experience, something that you've had occur, whether it's that duplex or something else, that because somebody might think, well, $10,000 and I have this $100,000 house, but what can I get from that? How does this how does it increase my net worth? And
well, rule number one is all real estate's local. So your returns are going to be primarily based upon your local market. Now that doesn't mean you have to buy locally, but where you do buy is going to be determined by the local market of where that piece of real estate lives. Now that said, that doesn't mean that you can't make your property better and be more attractive in the local market. So there's all kinds of things that can be done. In that regard. So as an example, back 3 years ago when office and retail had been declared dead, by the financial media, we bought an office building that had been full. I had managed it for one of my clients for several years. I knew the market, I knew the building, I knew the tenants. It just didn't get any better than that. And we bought that building without any trepidation whatsoever, even though the world was telling us office is dead. Nobody's ever going back to their office again. Well, you're in Michigan, I'm in the South. We kind of pretended like there was no pandemic from about June of 2020 on, and nobody was staying home for any reason, much less to go to the office. So we bought it. And while I was managing it, I couldn't do things that I wanted to do because somebody else owned it. So in the last 2 years, we've been able to work with the tenants. We've actually added some space. Internally, we took away some internal storage space and have converted that to rental space. We've been able to move some people around and take advantage of the increase of rental rates that have and so we bought it for 3.8, and really 2.5 years later, that building's worth $6 million today. We just had it reappraised, and so it doesn't always have to be slow jumps like that. And we're not likely to sell, but we did just pull out some cash on a tax-free basis. So now technically we have $0 in it. We still have a full building, and we still get quarterly cash distributions. And now that we've repositioned that building, which I'll say was fun and creative, and really got the entrepreneurial juices flowing. But now that we've got it, we sort of think of it as a basis of $6 million. We expect it to grow about 10% year over year for the next 5 to 6 years. At which point in time we may sell it then. But we were able to reconvert many leases to much more long-term leases, and it gives some people like dentists more space that they wanted, and who always write nice, really long-term leases. And things of that nature. So
that's great.
That's one example.
So if somebody is not as business savvy and they don't know how that might impact the value of it, can you kind of give a brief overview of how getting those longer term leases, some of those rental rates going up a little bit, how that impacts value of that property as well?
Absolutely. That's a great question. So the value of a piece of investment property is directly related to the bottom line, which real estate would generally call the net operating income. That's basically your rent less all your operating expenses. In business, we would call that EBITDA, our earnings before interest, taxes, depreciation, and amortization. So your operating income, and some multiple of that, a multiple, just say you're going to go buy a liquor store, it's worth 3x of the bottom line. So that's the multiple that we're talking about. And in real estate, we actually invert that and call it a cap rate, but it's the same concept exactly. So that's what your property is worth, is some multiple, and that also goes up and down with the market and with interest rates. So as interest rates have risen over the last few years, multiples have actually come down, or in our case, in the real estate world, cap rates have gone up. A cap rate is nothing more than what amount of return do you expect to make off of that investment. So cap rates have gone from 4% in some cases to now 8.5% or 9% on commercial properties. Where you get into a little bit of gray area is perhaps a rental house, where your house has a market of people who might want to buy it and live in it, or to other people buy it and rent it. So you get into a bit of a gray area as to what the house is worth. And in many times, and probably in most markets around the country where real estate markets are strong, your house probably has a higher value to the general for sale market than it does to the investment community market, unless it needs a lot of work or something like that. But in general, your property is worth how much money it will generate. And that's true for any business, frankly. Each property is a business in and of its own, and it's worth the amount of money that it can generate. Now, in the case of properties such as office or retail, where you have long-term leases and not multifamily, where the leases tend to be month to month, I mean, year to year, when you can book a long-term contract, that's essentially you can then market that property and sell it on future cash flow, rather than on what you're doing right now. So, and then that just becomes the negotiation between you and the buyer. But it, depending upon the credit quality of the tenants, then you're dealing with what's the reality that those people will actually stick around, stay in business, and pay those rents.
Yeah.
So, sorry if I got too far in the weeds on that, but
no, not at all. I think that is, it's important for people to understand that how that value can change, and it can change quite drastically and quickly based on some of the things that you do creatively in the space that you have now acquired and are able to, because you now own this space, like you had just mentioned. I think that was a great example. So for this period of time that you've been in real estate, it sounds like you've done different projects and different things. Has it primarily been individual with partners? Do you use your own capital? Do you get investors involved? How does that work for you?
Early on, I did it all by myself. Probably not one of those that learn to play well with others, as they say, and a little bit of greed in there. But as I started to move away from residential properties, because again, do what you love, I ended up with a whole bunch of residential units that I was managing, and I didn't like managing those units.
Sure.
People are crazy when it comes to their homes. So, and I'm much more comfortable or adept at communicating with business people. So I've moved into the commercial realm of offices and retail, and we do some storage as well, which is sort of a hybrid between crazy people and business people. But so that's kind of where we've ended up migrating to. So just the commercial realm, and as I moved into that, we syndicate some equity, we take on partners, we manage everything that we bring to the market. Usually we are the sponsor, we are the originator of the transaction. We go out and negotiate it, bring in partners, we guarantee the debt, and do all of that. So
awesome. So do you primarily focus on the market in which you live in, or are there certain?
We do.
Yeah. Okay.
Yeah, we have a territory of southern Middle Tennessee and northern Alabama.
Okay.
Our rule is anything we can get to within an hour.
Yep.
And so because we are the day-to-day managers, and if something comes up, we need to be able to get there in a reasonable period of time.
Yeah. And for those that may not have heard the term syndication, what does that mean in basic terms? And for those that might be interested in, like, how could I get involved in something like this?
Sure.
Talk a little bit about
syndication is just a big fancy word that means a group. A syndicate, you've probably heard of that. It goes hand in hand with the Regulation D, or the private placement rules of raising money, which are all about securities laws, which have been liberalized almost every year since 2012, mainly in response to technology. I have to say that the federal government, under Democrat and Republican administrations, have done a pretty good job, I think, of keeping up responsibly with the offering of these type securities to the public. And so a Reg D, which stands for Regulation D, it governs all the rules that come from issuing securities for opportunities privately. And privately means you're not filing for an IPO, and you're not a traded security, either bonds or stocks or anything. But although those two worlds are beginning to merge, because there are different rules under Regulation D, and different rules come with different things, we typically will use a rule called 506C, which allows us to publicly advertise our deal, and as long as we say for accredited investors only. Accredited investors is a definition by the Securities and Exchange Commission. It basically means people who are making over $200,000 a year and or have a net worth outside their home of $1 million. There's different rules for trusts and corporations and things like that, but generally that's the rule. And if you meet those rules, then you can invest in one of these deals. And sometimes the seller of the security can take your word for it that you meet those, and in others, whether you're an accredited investor, it has to be independently verified. So that's what a syndication means. And a sponsor is going out to the world, to the market, and gathering like-minded, interested people, and then they collect all the money and they move forward together as a syndicate to take down that piece of property. And generally, the minimums are $25,000, $50,000. The bigger the deal, the older the sponsor. Those minimums will go up to $100,000, $250,000, or even $500,000 sometimes. And that has everything to do with the sponsor's desire to limit the number of individual people he's dealing with. Generally, ours are $50,000, and we're usually going to have 30 or 35 people invested in any particular deal.
Okay. So for you, you've gained a lot of experience, both personally and then cooperatively with others, and then through syndications and managing property for others. And I've also seen for just even this past year, some of the challenges that people have faced in the real estate market, where they've maybe over leveraged themselves, or they've had themselves in a position where now the interest rates are going to go up and they are not going to be in a position to be able to afford that debt. And so how would you say that you protect your investors from getting into a difficult situation, or what have you learned to help produce consistent returns, or I guess more realizing those returns on the investment that you've not necessarily promised them, but that you've shown them and indicated that they would receive?
That's a great question. So when we bring a deal to the market, it's going to be a cash flowing deal from day one. I'm not against development. I'm not against a lot of things, but this is just what we bring to the market. We think cash flowing assets, whether it be a dividend paying stock, bonds, whatever, should be the foundation of anybody's investment portfolio. And cash flowing real estate is sort of the best of both worlds. You get growth in your principal as well as recurring cash flow on a regular basis. Now, you're not going to see 60% or 100% returns on a stabilized asset of any asset class, much less real estate. But that's because it's already stable. So, but what we bring to the market is, like I say, it's stabilized asset. We only do fixed rate debt, so we have no interest rate risk. We don't have any development risk because we're not doing anything development wise. And so the only real risk that the investor is taking is vacancy risk, because every landlord needs to know that whatever business your tenant is in, and that includes your rental house versus your office building, you're in that business too. You are extending them credit based upon the likelihood they will continue to be able to make those rent payments. And there are some tenants who've come along that we've passed on renting, or buildings that we've not purchased because we didn't like the tenant mix and the quality. And so there's a piece of it that you put your banker hat on and just like, I don't want to go do something with a brand new 1-year-old restaurant in it. As my dad, who was also a CPA, said, restaurants are the quickest way to get rich and the quickest way to go broke. It's because that business cycle is, 1 day to 1 week, and every turn of the cycle, that's where you book your profits and your losses, which
Yep.
is why restaurants go out of business so quickly. 80% of independent restaurants go out of business in the first 5 years. And you can break that down by year. So that's so that those are credit risks that we don't really buy into. So
Yep. I like that. You have an asset that's actually there. So people are investing in something real and existing, cash flowing today. And then you consider what that looks like with the mix of tenants and whether it'd be a good fit and that long term. And experience has shown what has been doing well and what has not done well. So I think that's a great strategy, and also just shows that you have that experience and are really thinking it through, not just in the quick dollars now, because that's usually where people get themselves in trouble. So
yeah. If you find something that's quick and fast in real estate, you should probably run.
yeah. Well, that's wise advice. So let's mark that down and keep that in mind. Now, I want to ask one more question. I always like to ask all of my guests. If you were to be handed $1 million today, no strings attached to that, what would you do with that money, and how would you invest that in your current endeavor or another one, and why?
That's a fun question. So I would buy more real estate with it,
Mhm.
frankly.
Mhm.
So not necessarily anything I'm currently doing, because those are already done
Yep.
deals, but I would definitely deploy that probably into 3 different pieces of real estate,
Mhm.
because diversification is important even in real estate.
Yeah.
And yeah, and I would expect, you know, uh, from the time I completed the investment, and that it would probably take me 6 to 9 months to deploy that
Mhm.
into 3 pieces of property. And in the 12 months after I had completed that, I would expect to get about $100,000 worth of income off of
Okay.
that. 10% is realistic. There are others, sometimes we'll start a deal out with 5% cash on cash.
Mhm.
Um, but the bigger you go, usually those numbers go up a little bit. So
Yeah. Okay. Well, I like that answer, and it fits in with what you're doing now, what you're passionate about, and what you've seen have success. So, Stuart, if anyone wants to reach out to you, what's the best way for someone to connect with you and find out more about you and about Harvard Grace?
easiest way to go is to harvardgrace.com. You can find my Calendly link there, and I offer to anyone and everyone who wants to book some time with me and chat. Please do so. I like to talk entrepreneurial endeavors as well as real estate. We also have some great resources there. One of
Mhm.
my favorites is why entrepreneurs should be investing passively in real estate. 5 reasons why. There's other resources there as well. We have a one pager on what is a syndication, which we talked about a minute ago. But
Yep.
yeah, please just go to the website and reach out and see what interests you.
Perfect. I love it. HarvardGrace.com, you said, right?
Yes, sir.
So I'd encourage everyone to just take a look. Take a look at those resources. Reach out. Schedule some time with Stuart. Like you said, and you're an entrepreneur. Maybe your passion isn't necessarily real estate, but if you can add that as an asset class, that would be one of the best ways you can grow your wealth of any other. Period.
Yes.
So
Yeah.
we'll start there and we'll end there. But Stuart, I want to thank you again for your time today, and I really appreciate the insights that you share, as well as just hearing a little bit more about what you're doing. So thank you again.
Thanks for having me, Doug. I'm Zach.
Of course. Yeah. No.